Good afternoon. My name is Eric Levinson, Head of Business Development for Vena Capital, and thank you very much for joining us this afternoon. I'm joined here by Michael Kokolari, our Chief Economist, Ismail Pili, our Head of Research. And this afternoon, we're going to cover a review of Q1 on both the Vietnam economy and stock market, and then importantly, turn our focus to forward-looking comments about Q2 and beyond. Now, before we talk about the economy and the market, I do want to highlight our performance. It's something we don't do enough. Now, if you are dialing in via Zoom this afternoon, you're either likely an existing shareholder or potentially debating an investment in Vietnam. And I just want to cover how our open-ended mutual funds have done year to date as well as the past few years. Now, as you can see from the slide on the screen right now, frankly, we've done an outstanding job on behalf of our clients. Year to date, even while the market's been flat, actually slightly negative, and this is through March 31st, all of our open-ended equity funds, either domestic funds or offshore funds, have outperformed their benchmark by over 6%. And then as you can see, trailing 12 months, 3-year and 5-year, we've outperformed the VNI across every time period. And I'll highlight the quarter-to-date performance as particularly strong because last year, 2021, our outperformance was significant. So to be able to outperform in a flat market environment, I really think shows that the research that Ismail and his team are doing and the work that our investment professionals on the PM side are doing really is outstanding. And so as people talk about, and we'll get to this a little bit later in the conversation, quote, is now a good time, I revert back to the old cliche of is time in the market, not timing the market. And that is really a global phenomenon no matter what market you're in. So with that as an introduction, let me turn it over to Michael Kokolari, our Chief Economist. Michael, here's the remote. Give us maybe a thought about Q1 economics, and importantly, what do we have to look forward to?
Okay, so the defining feature of the first quarter of this year in Vietnam, like many countries around the world, was the Omicron variant came. And as you can see on the slide that I have up on the screen right now, the new cases peaked in the middle of March. It was a pretty dramatic peak, and then have crashed since then. Now, importantly, the government did not impose any new COVID restrictions. In fact, the country essentially reopened for tourism in the middle of the year. In the middle of the month of March. But that having been said, the fact that there were a lot of people getting sick, albeit mild sickness, we know from the Omicron variant, that did weigh on both consumption and on manufacturing in Q1. A sufficient number of people were sick, again, mildly sick, that they couldn't go out to the store to shop, and also that they weren't able to go to the work in the factories. So both of those key areas of Vietnam's GDP were modestly dampened, not big, not a huge impact, but some impact in Q1. And against that, what happened was, of course, global energy prices soared in Q1, and because of that, oil production took off. Vietnam is an oil producer. The other impact, and so the net effect of the two is you can see that GDP growth picked up slightly from Q1 of last year to Q1 of this year. Now, the other impact of oil prices soaring is that inflation ticked up from 1.4% in February to 2.4% in March. That 2.4% number is still fairly low, and that was primarily driven by higher oil prices. That number will tick up as the year progresses, but we think that inflation will stay in a manageable level. So that's what happened. That's the story of the main story of Q1. Going forward, we do still expect 6.5% GDP growth for the full year. And we see a lot of very positive indicators about how growth is likely to unfold for the rest of the year. First of all, I just mentioned that the main issue that put a slight dampener on growth in the beginning of the year was Omicron, and that's basically over now. The things that I'm looking at I really like to follow the electricity production because this is a easy to measure variable, and as you can see on the slide I have up on the screen, it really picked up in Q1. So that's a good sign that the underlying strength of the economy. And the other thing is that FDI inflows remain resilient. FDI companies are importing a lot of the production materials that they need to produce the products that they'll export. So we should see the trade surplus getting wider as the year progresses. These are very positive leading indicators. And finally, I also have on this screen is that the anecdotal evidence of the strength in Vietnam's economy is quite compelling. Everywhere you go, things are full. This is not just in the center of the main cities, but on the periphery districts of the main cities and the second-tier cities. Everything's busy. You really, on the ground view is very, very strong.
So this isn't really anecdotal. This is what we are experiencing.
This is what we're experiencing in real life, trying to get into a restaurant, trying to get into a taxi, and it's buzzing. Things are really buzzing, yeah. So that's one thing that we get asked about a lot is how things are progressing for the rest of the year. The other thing we get asked a lot about, of course, is what about the impact of Russia, Ukraine, and China on Vietnam? Russia, Ukraine is really a non-issue for Vietnam. I have up on the slide here, the only thing where we have a little bit of impact is about 4%, actually less than 4% of the tourist arrivals to Vietnam pre-COVID were from Russia. There were particular towns that are more impacted, some seaside resorts, but this is not a big impact, as you can see on the slide here. The story with China is a little bit more nuanced. It is our huge neighbor to the north, and China is Vietnam's biggest trading partner. Now, the U.S. is Vietnam's biggest export market, but in terms of two-way trade, China is very important because it's right up there in the north. And the right way to think about this is that Vietnam really has very limited exposure to what's happening in China's domestic market. So everything having to do with the real estate and the COVID lockdown in Shanghai, Vietnam as a country is not really very exposed to that whole story. The way that trade works between Vietnam and China, as I have up on the slide here, is that there are two industries, high tech, which is over 50% of the trade flows between Vietnam and China, and then also garments and textile is still important. And basically what happens is there's a lot of trade back and forth between these two countries, which is really about supply chains. So the supply chains in these industries kind of are spread across the two countries. But when you net it all out, the right way to think about Vietnam's trade with China is we essentially net everything zeroed out. We import a lot from China, so we have a big trade deficit with China, as you can see on the screen, and we do the processing work here in the factories, and we sell on to the U.S. So we have a big trade deficit with China and a big trade surplus with the U.S., and that has been getting bigger and bigger after the trade war from 2018, 2019. So not a lot of impact on domestic China issues. The last thing I want to touch on just very briefly is that the value of the Vietnam dong has stayed remarkably resilient this year, despite everything happening with all the global events. As I just mentioned, we expect the trade surplus to widen as the year progresses. 1% of GDP trade surplus last year, we'll probably do 4 or 5% this year. And despite the fact that the dong has been fairly strong, one of the things that we get asked more is, has the dong been too strong that we're losing, we're at risk of losing our export competitiveness? Is that going to have anything to do with FDI, in the future? And on the last slide here, I basically answered that question essentially by pointing out that China's currency is appreciated even a bit more than Vietnam's against the US dollar. And so long story short, we're not losing any of our competitiveness. Also, factory wages in Vietnam are 2/3 below those in China. So it's still a very healthy competitive position for for Vietnam as an exporter to the rest of the world. So.
Excellent. Well, we'll come back to you during Q&A. So we've heard about the macro, and we'll talk a bit more. Ismail, what people really want to know is, what about the markets? And so, as we just discussed, performance for our funds in 2021 was fantastic. We've actually started the year very, very strong, even though the market was basically down 40 basis points or 50 in US dollar terms. So kind of maybe walk us through what happened in Q1. There were a couple of headlines that caused some risk-off type of sentiment. So maybe you can talk about those, one on the equity side, one on the fixed income side, but that actually impacts the equity market as well.
Sure. So Eric, as you mentioned, Vietnam was pretty much flat Q and Q. And if you break it down by sector, you'll find that it's actually the banks, real estate, and consumer staples that's actually been dragging down the index. What's been lifting it has been the consumer discretionary, utilities, and IT. And in that regard, the balance of the gains on the latter sectors I mentioned versus the former has led to that flat performance. Mind you, you take a look at the performance of the trading value of the market, and it's still quite healthy. 1.14 has been the average for the quarter, a little bit off from the peak that we saw perhaps in the fourth quarter, but we continue to see record number of new accounts being opened. In fact, we surpassed 300,000 new accounts in March alone. We're now knocking at about 5 million active accounts, and that's about 5% GDP penetration in terms of GDP. We've already said in previous broadcasts that we are probably just seeing the start of this growth in the retail segment. If we do the parallels again for Taiwan, this suggests that there's probably a multi-year runway where, again, if you recall Taiwan, they started at the same level that we are, now they're about 80%. So we're not expecting that to dissipate. We do acknowledge the fact that there's a lot of heightened uncertainty at the moment. Some of the risk that we kind of look at, Mike alluded to, includes Russia and Ukraine, but as I said, not much impact going on as far as the economics is concerned. Also, with regards to the Fed pivoting, that might have more of an implication for the rates in the sense that you have to move in line with the U.S. You know, when the U.S. sneezes, the world catches a cold. And so it's hard to fathom that we are that disconnected. But we will see a slight increase in interest rates, but not to the detriment of the market. And finally, in terms of inflation, we are not really affected by that at the moment. As Mike alluded to, we're probably going to hover between the 3 to 4%. The risk is that we go beyond that, but it's something that we're not overly panicking about. So again, the factors that people seem to be concerned about outside is not as material as it is here in Vietnam. The way we're looking at the market at the moment is we still are quite upbeat. We do think that the recency bias suggests that people are going to be quite cautious. It's a little bit risk off. And we can see that in the sense that the value turnover has dissipated just a little bit, not much, but that's probably going to be that type of environment until this heightened uncertainty kind of dissipates. If we had that forward-looking glass or that crystal ball gazing exercise, we would think that the roadmap to here is that we do expect a higher VNI by the end of the year. The earnings remain robust, roughly 21 to 25% as it stands. And the notion that earnings tends to lead markets suggests that that's probably where the market might be headed, maybe around the mid-teens level, not as high as the 36% we had last year. At the same time, we have to acknowledge the fact that there are some headwinds that we're seeing right now caused by, as Eric alluded to, some concerns about certain issues, specifically on the real estate sector and the corporate bond market. On the real estate sector, a company called FLC has had its chairman getting scrutinized, investigated with regards to some potential wrongdoings. I use the word potential, and that has spilled over in terms of sentiment, particularly in the real estate sector. Adding to that situation is another company, THM Tan Hoang Minh, if I'm pronouncing it correctly, is another one that has its corporate bonds being scrutinized. About 9 issuance amounting to about 10 trillion VND, which is equivalent to about $440 million. Of which there's questions in terms of either the use of proceeds and also the transparency with regards to the company itself and its subsidiary. The bottom line behind this is it is going to create a lot of noise, a lot of uncertainty, and that's going to put people perhaps a little bit to the sidelines, but not to an extended version. The way we look at this is going to be long-term good in the medium to long term. This is not an isolated situation for Vietnam. Even the U.S., we've seen this happen, of course, with the WorldComs, the Enrons, and so forth. The Volkswagens in Europe. This is just another one of those situations where the government or the authorities are looking to make sure that the transparency and the governance and overall acceptability of this market is going to be something that they have to try and develop. And this is part and parcel, part of that story. So we are remaining bullish. We're not detracted by the fact that there's going to be a heightened volatility and heightened uncertainty. As far as sector is concerned, we do follow earnings leading the markets. And in that regard, we're still upbeat on the banking sector, real estate, and consumer discretionary. We're just starting that recovery phase. As Mike and Eric alluded to, it's tough to get restaurants. It's hard to get taxis. That is just reflected, the start of this recovery phase. that if we draw parallels with the US and Europe in terms of that such reopening situation, then you should think that cyclicals and value might have a hand with regards to your focus in terms of preferred sectors.
All right, well, terrific. So with that, we'll open up the floor for questions. So if you have any questions, please type them into the chat function. And as we wait, I will ask Michael our first question. All right, and so here we are now with the Q&A portion. And so Michael, I guess the first question goes to you. In an earlier webinar, you had talked about maybe the need for Doimoy 2.0, which for those of you that maybe didn't follow the previous webinar was kind of a big infrastructure package or certainly big plans from the government. That hasn't happened. Are you surprised? Are you disappointed? What's the result there?
Well, in one way, I could say I'm a little bit pleasantly surprised, even though the prediction hasn't exactly worked out the way I had anticipated. What that whole story was predicated on, this is something we did back in the fall, was the idea that when countries in the past faced like really severe economic crisis, like the oil crisis for Japan that had such a devastating impact on the country, it prompted the country to like sort of take dramatic actions, to reform, restructure the economy. And basically what we've seen in Vietnam is that the severity of the COVID crisis has ended up not being as much as kind of what it seemed at that time when we made those predictions in those webinars. In fact, what we've seen is that the economy is just really roaring back to life. I mean, at an anecdotal level, I kind of talked about it a little bit during my slideshow, but everything is booming in the periphery districts of the city. And so for that reason, I think the government perhaps felt like maybe they would sort of hold back some of their, the possibility of doing dramatic things if and when Vietnam ever encountered a real severe situation. But the situation, frankly, is not severe here now.
So Ismail, here's a question that's coming in from the audience. No surprise. We're gonna ask this one if necessary, which is the market has dropped significantly. Is this a panic sign? Is this a downtrend? And just think of it this way: it was actually down again today. So we were down 40 basis points through the end of the first quarter. As of the end of today, we're down about 8.1, so we're looking at around 7.5%, 7.7% maybe in the last 2.5 weeks. What are your thoughts?
Well, sentiment has certainly soured on the back of the FLC and the THM issue. And the big thing to note about this might be an event situation that has longer-term positive ramification. You could accuse that the retail might be panicking a little bit, but I think for us, which is more institutional in terms of our approach, we would actually treat this as a potential either buying opportunity or a chance to rebalance our portfolio towards the stocks and sectors that we do like. If we had to take a step further, at the moment when it's a little bit more risk off, you would tend to shy away from the smaller caps, the small and mid caps, and maybe focus on the blue chips. And that's probably going to be our approach. That approach is no different than what people have been doing in other parts of the world, where in a heightened risk off or more risk aversion situation, the big caps do much better, or at least becomes the more focal point, and the small mid caps tend to find less favor. I think that's going to be the same approach that we're going to take here.
I'll ask you a follow-up, and I'll maybe put it in two ways, because interestingly enough, some of the large caps are the real estate names and the banks, and they've actually been the leaders until recently. Now they've been putting downward pressure. So would you avoid some of the beaten up real estate stocks, or are those maybe just getting beaten just because FLC, and so all of a sudden you have just people saying, let me avoid a sector, but now's a good opportunity to pick a couple that have gotten beaten up unnecessarily?
Yeah, I think the latter point is how we're going to approach it. As I said earlier, earnings tend to lead markets, and the earnings at the moment remains intact. We've been talking amongst our team members with regards to the outlook for the real estate in the banking sector, and they're still quite adamant to say that the earnings forecast that they have, which is about 32% growth for the banking sector, 25% for real estate, remains in place. They have not seen any cause for consternation as far as earnings is concerned, but we do acknowledge the fact that at the moment the sentiment is terrible simply because of the fiasco that we've heard with FLC and THM, and of course the corporate bond market as well. The pre-sales that the real estate companies have are based on the old existing projects. It's not about the new projects that need financing, it's about the old ones that already have most of the financing in place and will continue. And in the meantime, Mike is painting perhaps a GDP growth of 6.5%. That should bode well for the banking sector. not necessarily about higher interest rates, but even on the asset quality side being improved, and that means provision release, which means credit costs will probably provide that nice swing factor to the bottom line for the banking sector.
So again, frankly, it's being selective, not just buying a basket.
Yeah. I think in previous webinars we talked about my personal bias against state-owned commercial banks, but right now Vietcom Bank, BID, CTG, basically state banks, are probably doing quite well, with exception of the last one, on the notion that the provision release that they've had to do last year will lead to a stronger bottom line. Again, we look at stocks on a medium to long-term basis, and that's probably where we're a little bit more concerned about the state-owned commercial banks. We would still prefer the private banks that we see to have greater commerciality.
Excellent. So Michael, another question came in. Actually, there's two that have come to the macro side. And again, if you have a question, I'm looking at my iPad here, just type it in, I'll read it. If oil prices double, what impact will that have on the forecast in the economy?
Yeah, that's a good question. There's Vietnam is a net energy importer, not a major one, but it is it would be a drain on the economy. What we've predicted so far is that the increase in oil price that we've experienced so far, which I think is more or less a double, 80% or so, well, it depends on day by day, would essentially suck about, you think about the money that gets sucked out of the consumption economy. People don't have as much money to spend because they're using it to fill up their motorbike. That would probably cut about 0.75 percentage point of GDP. So that's the existing double that we've had. So if we had another double, it would be probably about another percentage point or something. And again, to be clear, that's like, consumption is 2/3 of the economy here. People have less money to spend because they put it in the tank. So that would probably trickle through to about a percentage point on GDP.
All right. And another question here for you. Can you quantify the impact of the devaluation of the yen?
Okay, well, quantify would be difficult, but I can talk a little bit in general terms that Japan and Korea are the two biggest FDI investors to Vietnam. And both of those stories are not really about currency. In both cases, these countries are experiencing a situation called secular stagnation. The demographics are rolling over, they have a bunch of economic issues, blah, blah, blah. And that's why they have been kind of compelled to forced to invest abroad. Japan starting in the early 1990s, Korea really starting from around 2015. These countries kind of essentially have to invest abroad. Now, the effect of the currency depreciation is not nothing, but the reason I had this slide earlier in my presentation about this general topic of how the dong is doing versus the rest of the world is kind of to highlight the idea that which is kind of also covers this question, is that the types of products and the types of things that are actually made in Japan that will get more competitive are not really, there's no overlap with the stuff that's being made here in Vietnam. As a side note, both Ismail and I worked in Japan before I was there for 8 years. I do think that the currency depreciating will make those Japanese companies more competitive, but they make stuff that's not made here in Vietnam. So if you want to buy Toshiba as a stock investor, currency hedged, of course, that would be interesting, but it won't have much economic impact on Vietnam, sorry.
Any perspective on that as well?
No, I mean, it's mostly a macro question.
Yeah. Okay. Well, good. I'll bring then maybe somewhat of a macro, maybe a stock question. The question here comes in from Sally as well. Vietnam is a resource-rich country, but materials are not a sector highlighted as expected to do well. What are the team's thoughts?
Well, materials is dominated by one stock, which is HPG, Wafat. And right now, they're at full capacity. The price is pretty much dependent on what happens with regards to the demand. And at the moment, it means that we're looking at either single-digit growth or perhaps a contraction, just simply we're coming off such a high base. The foreseeable future is if they're able to expand the capacity, then this company, which is of course the biggest part of the materials sector, would probably bring and lift the whole sector up. But at the moment, the other constituents are actually quite tiny. They're not as big. And so it's a one-horse pony, or one-trick pony.
So, by the way, Wafat was up last year and the year before, how much?
80+%, and then 100 and plus.
Right. So I think the perspective here is that it's a stock we've owned in our closed-end portfolio of VOF. We've owned it in our open-ended funds as well. We've done really well on Wafat. Now we're just not as positive because it's run up 200% in the last 2 years. Basically.
Well, it just goes back to the earnings outlook. Again, earnings lead markets, and in that sense, Single-digit growth is not what we look for. This is Vietnam, which means growth is a focus. And at the moment, the growth outlook, as I mentioned, is about 21% EPS growth. We do think there's opportunities for that to nudge higher, much higher, based on the macro backdrop. And even early indications at the moment. The first quarter results are trickling through, and the likes of consumers are beating everyone's expectations, and it will have to be nudged up. Oil and gas benefiting from the higher oil prices, the margins are increasing. Likewise, utilities, volumes are picking up because of the higher economic activity. At the same time, they're able to pass off higher prices. So you're ticking off all the boxes. That 21% looks very conservative for Vietnam at the moment.
So let me follow up on that, because 21% is the consensus for the market. Your team, obviously rank stocks, you have buy recommendations, share with the portfolio managers. For your favored stocks, what is the earnings growth of your kind of coverage list that you really push towards the PMs?
Right. I mean, each fund, of course, will have different profiles, but it's suffice to say that probably 35 to even as high as 50+% is the composition growth of the stocks that we have in the different funds.
Yeah, and I'll make one note. Our UCITS fund, VVF, has the earnings of 35% versus, actually it's more like 38%. Interestingly, through the end of March, had a PE ratio of 10 versus the market of 14. And so it is interesting. Again, we talk about the market because that's what people is, you have to get the buy-in on Vietnam first. But what we're seeing in our portfolios that are actively managed with a very high active share, we're buying faster growth, actually at cheaper prices. And so that's really what's surprising, is not only we don't have to pay up for growth, we can actually get growth a little bit cheaper, and that's really interesting about the market. Michael, a question coming back to you. Does your GDP growth include international tourism? We talked about that last year, and specifically from China, and maybe talk about China a little bit in terms of tourism, as well as if there is a prolonged, I guess if China maintains their zero COVID approach, what does that mean for supply chain? So talk maybe tourism first, and then supply chain second.
Right. Well, the short answer on tourism is no. We're not counting on any Chinese tourists to come back. Chinese were about a third of tourists in Vietnam pre-COVID, and none of our, we just assume that's going to be a zero this year. About the supply chain issues.
So 6.5% can be achieved without that.
Without, yeah. That includes other foreigners coming back, which is, by the way, I was mentioning my colleagues before the webinar. I was up in Hanoi this morning and flew down, and it was just a sea of people in the airport. I mean, it's incredible, foreigners and locals traveling. But we haven't penciled in any Chinese coming back this year. About the supply chain issue, let me say a few things. One is that we'll give the disclaimer we always give. We're not epidemiologists, but if we see kind of what's happening with the Omicron wave in Vietnam and in countries around the world, I would really expect that by the middle of the year, this is going to be all kind of washed out. Who knows, but that's kind of my anticipation. And the FDI companies in particular that would be affected by supply chain issues, they have abundant inventory, because what happened last year is that Vietnam's imports grew by about 30%, but exports only grew about 20%. And remember, because we had the COVID lockdowns here, the factories imported lots of production materials, but then they weren't actually able to use up all their inventories to produce products. So they're already sitting on pretty big inventories. In Q1, the imports of production materials that are required to make high-tech products was again up about probably over 30%. So the companies should be okay until the middle of the year. I mean, if it persists after that, we'll see. But so far,
well, middle of the year is 2 months away.
Let's say July, August. Yeah, time's going fast. Yeah.
Okay, economist, but it's the fourth month. Yeah. Okay, so here's a question for you. What are the key short-term and long-term risks to the fundamentals of banks, not stock prices, especially retail and SME-driven banks?
Yeah, the short term is probably going to be the asset quality situation. We have this assumption that everything's going to be hunky-dory fine, that there's going to be provision release. But what if all of a sudden this actually causes enough pressure? Because even the minute increase in interest rates, which we don't think will happen, could cause asset quality stress. The other thing is with regards to credit growth. Are they lending to certain sectors that could be deemed risk? At the moment, some of those risk exposures that people have talked about could be perhaps developers, or perhaps even with the constructions. So it sounds like it's more real estate related. And the definition of credit growth here is not just about loans, but also bonds. And as we talked about earlier, there's that little bit of an issue with the corporate bond market. And a lot of the developers were issuing bonds to try and facilitate or accelerate their land banking activities over the past couple of years. So that's probably more like the short-term issue, basically on the asset quality front. Longer term, it goes back to the idea that there's too many banks here, over 40 plus. Consolidation has to happen eventually. We've seen this across the region. How that happens, whether it takes like a Malaysia 2000 where the government forces the 20 to 10, or it takes its own accord where private banks decide, you know what, it's not going to work in the late 90s, like in the Philippines or even in Singapore, where they decide, let's just get together and shrink the field. That's important because it allows greater efficiency. The problem with all that, of course, is for foreigners to try and come in, the limitation in terms of how much they can own. And under the notion that foreign investors or foreign banks might actually apply some improved know-hows or processes to improve either the efficiencies and revenue capabilities of the banking sector. And of course, the second one I'd highlight longer term is margins. Margins will eventually have to come down. At the moment, we're forecasting about 4%, which is extremely fat. But the pressure that'll come from either higher penetration rate and also in terms of competition, it's inevitable. It will eventually happen, which means they need to develop the non-interest income component, which is the fee side, which is extremely small at the moment, maybe about 11 or 12% of whole operating income. The share of non-interest income is still maybe high teens, 20%, which makes it one of the lowest in the whole region. So those are probably just some of the broad, pictures stuff I talked about.
That's 4% net interest margin, NIM, and that's quite wide compared to the rest of
It's very fat, yeah.
I probably should have mentioned, not only is Ismail a head of research, he also has been a bank analyst for 20 plus years.
Bank guru, sorry.
Bank guru. We're going to change the title on the card to bank guru. Okay, so thank you, Ismail. And it covered banks, obviously, in other parts of the region. So another question for you. This one might be a little bit harder to answer. We talked with the head of Jose, at our last investor conference in the fall. We talked about the merging, or at least the coming together of the Ho Chi Minh and Hanoi stock exchanges. Is there a tentative schedule for that? And then any relevant news on potential upgrade of Vietnam to EM status?
Yeah, it's a perennial question, isn't it?
Yeah.
It keeps getting pushed as we get closer to the ultimate target of 2025. Supposedly, this is the end stop. You have to have that FOL in or lifted. But we haven't heard hide or hair that there's any progress with regards to FOLs being lifted. We all know the consideration. This is what you need for MSCI ascension to emerging market class, notwithstanding things such as unsettlement and omnibus accounts. But we haven't gotten any new progress or development.
I'll add in some of the meetings I've had with some, let's just say, advocacy groups, there's a couple of tidbits of information that might be worth sharing. And one of them is that people have said that perhaps Vietnam will be upgraded by FTSE before MSCI, whether that's true or not, but I think that will hopefully put upward pressure on MSCI. And then FOL withstanding the other issues, which are actually just as important, but don't get the headline risk, more technology-oriented in nature, the settlement, things like that, those are actually kind of done with, meaning the exchange have solved that. So I wish I could tell you we had a date for you. We don't, but if you look at virtually every other criteria, whether it's liquidity, whether it's cap size, whether it's really all of them, Vietnam would pass that threshold. So I think really it is kind of that FOL piece that's remaining. So sorry we don't have a better answer, but our view is it's still a great place to invest in until then. Michael, a question came in for you, which is, what are the risks? We paint the situation very, very positive. We're out here every day. It is booming. What are the risks to your GDP forecast? Maybe not your forecast, but what is the risk to the Vietnam economy?
Right. Well, I'm quite confident about the domestic story. I mean, I keep going on and on about the anecdotal side that matches the numbers. One thing I'm a bit concerned about is that manufacturing is 25% of the economy. I'm personally concerned about the potential for a bigger than expected slowdown in the U.S. Right now, we have the University of Michigan Consumer Sentiment Survey is sort of the lowest since the 1980s, and a lot of people know there was a big negative earnings guidance from Restoration Hardware that kind of shook up the market a little bit. So a lot of those products that are made here in Vietnam, there's a risk that the the demand for them could kind of drop. Right now, we're penciling in about 7-8% growth for the manufacturing sector this year compared to double-digit growth last year. But if the economy in the U.S. weakens more than what I'm anticipating, that would weigh on us a bit.
So the biggest risk, is if the U.S. slows down, the rest of the world slows down. It'll certainly impact.
Yeah. Or the question we had before about if oil double, which we don't expect, but that kind of these are all exogenous. There's nothing endogenous. We're not worried about NPLs. We're not worried about some little scandal not going to impact people's behavior, spending, this kind of stuff. Although it gets the headlines, but it's not going to have an economic impact.
Sure, it is, and I'll ask you a follow-up. So you had talked about a lot of companies are now reporting earnings. Are you seeing any companies that you're revising downward, or are you basically revising nearly everything upward?
I think everything is upwards.
So there's a disconnect between earnings revisions and actually what's going on in the market.
Yeah, the banks and real estate have not reported yet, but consumer, oil and gas, utilities, they've shown, revealed some of the hands that's going on at the moment. Again, the biggest risk and swing factor in the market will have to be from the banking side. The real estate seems quite intact because it's not about future projects of which these financing is important, imperative for that. It's really just about what they've already launched, what they already introduced, but the pre-sales continue for those things. So the earnings are pretty much baked for this year and next.
All right, and a question just came in here about real estate. Any risk to the real estate market in Vietnam, especially now that interest rates are for sure increasing? And interesting, I'm not sure where the question's coming from. Interest rates here are...
Yeah, they're not really significantly increased.
No, but mortgage rates here are high compared to the rest of the world.
Right,
I was talking to someone that is paying 9 or 10% on a mortgage. So I don't know if that's going to be the driver. I guess.
Yeah, it's interesting the question came in because you were talking about that was popping into my head like, well, it's not really going up that much.
So real estate in Vietnam at risk, and if so, is it due to interest rates or would it be something else?
No, I don't think it's going to be interest rates. The thing about frontier emerging markets is that they have a high tolerance for high rates. The rates that Eric was talking about, your first year mortgage rate here is about 6.5% or 7%. Thereafter, it's about 10 or 11%. If it goes up by 1%, even 2%, I think it's about, can I afford my monthly? That's how they kind of look at things in terms of servicing the debt. And 1 to 2% is not going to be too meaningful for them.
Yeah, and what we've seen, candidly, is term deposit rates have gone up a little bit, but not that much.
Like 0.5 percentage point or something. Mm-hmm. In fact, on the affordability one, we've looked at it before. We saw that for like middle, upper middle income couple, their combined salary is going to be like less than a third of their mortgage payment. So. The mortgage payment would be less than a third of their. Yeah, that would be weird.
We're talking San Francisco back all of a sudden. All right, let me come to you for a closing comment. So again, I think that the headline today is, we are very bullish, yet in the last 2 weeks, the fundamentals necessarily haven't changed, but sentiment has changed completely. We went from, again, positive beginning of the year, end of the quarter, negative 40 basis points. Now we're down 8.1. Fundamentally, nothing's changed. Maybe earnings have actually gotten better. So what's the guidance for people looking at the market?
Right. You touched on it earlier. We're not here to time the market. It's about time in the market. And this correction, as I mentioned, is probably presenting good opportunities to pick up some names that might have proved too expensive at the start of this year. There are fantastically well-run companies here that are now offering at a cheaper price than when 2022 started. And the retail crowd, of course, will be swayed by the recency bias. And that recency bias is all about the negative headlines on the real estate side, potentially spilling over to the banking side, notwithstanding the exogenous stuff with the Fed pivot or the Russia-Ukraine war. So for us, we actually see opportunity. We're not gun shy. At least that's how we're taking our approach.
All right. And Michael, any last comments from you?
I think you summed it up really well. Yeah.
Well, thank you very, very much for joining us. Iz and Michael, thank you. If we were not able to answer one of your questions, or if you have a question that comes up later, please email us directly. And if you want to forward this to your colleagues, we should have a copy of the webinar on our website by tomorrow, or certainly by Friday. On behalf of Vena Capital, thank you again for your consideration. And we look forward to doing this at the end of the quarter. So we'll see you again in July. Thank you very much.